Your bank account is about to get a boost and the timing could not be more critical. At this very moment, millions of Americans are awaiting a January Social Security payment that will look different from any other they have received this past year. This payment reflects the freshly applied cost of living adjustment for the new year. For the average retiree, this translates to an extra $56 arriving each month. However, what most people fail to realize is that your specific payment date is dictated by your birth date. If you were born between the 11th and 20th of any month, your funds are scheduled to arrive tomorrow. The Social Security Administration operates on a strict weekly schedule, distributing payments on Wednesdays. Those born between the 1st and the 10th receive theirs on the second Wednesday of the month. Individuals born between the 11th and the 20th see their deposit on the third Wednesday. Anyone with a birthday falling between the 21st and the 31st gets paid on the fourth Wednesday. This systematic approach affects over 71 million Americans who rely on retirement benefits. Understanding the precise timing of this income is crucial for effective budgeting, paying bills, and long-term financial planning. The adjustment of 2.8% pushes the average monthly retirement benefit upward. Yet there is a significant catch that often reduces the actual take-home amount, and it demands immediate attention. The first essential point to understand is that this is not merely another routine deposit. This particular payment represents a fundamental shift from the benefit amount received throughout the previous year. The administration has applied a cost of living adjustment that recalibrates the entire calculation of your benefit. While this sounds like straightforward good news, the reality is considerably more complex. That widely reported increase of $56 for the average retiree might sound modest, especially when considering rising prices at grocery stores and creeping utility bills. What makes this adjustment noteworthy is that the 2.8% increase is actually higher than last year's 2.5% bump. This indicates an acknowledgement that inflation has not fully subsided. The calculation is based on consumer price index data from the third quarter of last year compared to the same period the year before, revealing that prices are still climbing, albeit not at the breakneck pace witnessed during the most difficult recent years. Your personal increase depends entirely on your current benefit amount. If you receive more than the average, your dollar increase will be proportionally larger. If you receive less, your increase will be smaller. The percentage remains the same across the board, but the actual dollar amount varies significantly from person to person. Some might see an increase of $30 or $40, while others could see $70 or $80 added to their monthly check. The key is to consult your own benefit statement and avoid comparing your situation to broad averages. Now we arrive at the factor that catches millions of Americans off guard annually. It is the reason that headline increase can feel like wishful thinking upon checking your bank balance. Medicare Part B premiums are rising significantly, from $185 per month to $220.90. That is an increase of nearly $18 each month. For most beneficiaries, this premium is automatically deducted from the Social Security check before the funds ever reach your account. Therefore, while you gain that $56 on paper, almost a third of it is immediately recouped to cover higher Medicare costs. This dynamic understandably frustrates many people. You pay into the system for decades, only to feel as though the government gives with one hand and takes with the other. The underlying reality is that healthcare costs have climbed much faster than general inflation for years. The 9.7% increase in Medicare Part B premiums is more than 3 times the size of the cost of living adjustment on Social Security. This marks the third consecutive year where Medicare premiums have risen faster than the adjustment, a trend that worries policy experts because it means retirees are losing purchasing power even as their benefits technically increase. Consider a concrete example. Suppose you received $2,000 monthly in benefits last year. With the 2.8% adjustment, your new gross benefit becomes $2,056. That is a $56 increase. However, after deducting the new Medicare Part B premium of $220.90, your net deposit becomes $1,835.10. Last year, after the $185 deduction, your net was $1,815. Your real spendable increase is therefore only $20.10 per month, a far cry from the $56 initially anticipated. A provision known as hold harmless protects some individuals from seeing their net Social Security check decrease due to Medicare premium increases. This affects roughly 4 million Americans, typically those with the lowest benefits. If your monthly benefit is around $640 or less, this provision caps the premium increase at the amount of your cost of living adjustment, ensuring your net payment does not fall below the previous year's amount. While not ideal, it prevents losing ground. This protection does not apply to everyone. If you are new to Medicare, if your income is high enough to trigger an income-related monthly adjustment amount, or if you are in a Medicare savings program, the hold harmless provision will not shield you. The income-related monthly adjustment amount is a particular surprise for many, especially those who had higher income 2 years prior. Medicare calculates your premiums based on your income from 2 years ago. Thus, your premiums for this new year are determined by your tax return from 2 years prior. If you are single and your modified adjusted gross income exceeded $109,000, or if you are married filing jointly with a combined income over $218,000, you will pay significantly more than the standard Part B premium. These surcharges can add anywhere from $81 to $487 monthly on top of the standard premium. These additional charges impact about 8% of Medicare beneficiaries, and they are not protected by the hold harmless provision. The situation grows more complex when considering other Medicare costs deducted from your check. If you have a Medicare Part D prescription drug plan, those premiums are also deducted and are also rising. Unlike Part B, there is no hold harmless protection for Part D, meaning those increases can directly reduce your net Social Security payment. The same applies if you are enrolled in a Medicare Advantage plan. Those premiums vary and are subject to increases. This is why experts emphasize reviewing your Medicare coverage annually during the fall enrollment period. You may find a plan that costs less or provides better coverage for your specific needs, potentially saving hundreds or even thousands of dollars over the year. There is, however, a piece of genuinely good news in the form of a new senior deduction included in recent legislation. This tax provision could save many retirees a substantial sum when they file their tax returns next year. If you are 65 or older, you can now claim an additional $6,000 deduction on top of the regular standard deduction and the existing extra deduction for seniors. For a married couple where both spouses are over 65, that is potentially $12,000 in additional deductions. This applies whether you itemize or take the standard deduction. The catch is that this enhanced deduction is income limited. It is available in full if you are a single filer with a modified adjusted gross income up to $75,000 or a married couple filing jointly with income up to $150,000. Above those thresholds, the deduction phases out gradually, disappearing completely once income reaches $175,000 for singles or $250,000 for married couples. Furthermore, the deduction is temporary, lasting only from this tax year through the 4 years from now. Therefore, you must be aware this benefit will sunset unless Congress acts to extend it. In practical terms, this senior deduction means many middle-income retirees will see their federal tax burden reduced by several hundred to a couple $1,000s. For someone in the 12% tax bracket, a $6,000 deduction translates to about $720 in tax savings. For someone in the 22% bracket, it is closer to $1,320. This will not appear directly in your Social Security check, but will make a tangible difference when settling with the IRS. It is crucial to distinguish this deduction from the taxation of Social Security benefits themselves, the rules for which have not changed. If you are single and your combined income is between $25,000 and $34,000, up to 50% of your benefits can be taxed. Above $34,000, up to 85% can be taxed. For married couples filing jointly, those thresholds are $32,000 and $44,000. These fixed thresholds, unadjusted since the 1980s and early 90s, ensnare more people each year due to inflation. Strategic financial planning involves understanding how all these pieces interconnect. If you are near an income threshold for the senior deduction phase-out, for benefit taxation, or for income-related monthly adjustment amount surcharges, you might adjust your financial moves before year-end. This could mean delaying a Roth conversion, managing withdrawals from traditional retirement accounts, or timing investment sales carefully. These are conversations best had with a tax professional or financial advisor who understands retirement-specific rules. Revisiting the payment schedule is also wise for budgeting. Remember the pattern. Birthdays from the 1st to the 10th trigger payment on the second Wednesday, the 11th to the 20th on the third Wednesday, and the 21st to the 31st on the fourth Wednesday. Exceptions exist for those who began receiving benefits before May 1997, and supplemental security income recipients who follow different schedules. Knowing your exact deposit date helps plan bill payments and avoid overdraft fees. The broader picture reveals a troubling pattern where Social Security increases fail to keep pace with retirees' actual costs, primarily driven by healthcare. The cost of living adjustment is calculated using a broad inflation measure reflecting younger workers' spending, who typically devote a smaller portion of their budget to medical care. Proposals to use an inflation index more representative of senior spending have not been adopted by Congress. Meanwhile, other Medicare costs are also rising. The Part B deductible increases from $257 to $283. The Part A hospital deductible jumps from $1,676 to $1,736. These are not directly deducted from your check, but represent out-of-pocket expenses that rise faster than your benefits. Finally, note that the earnings subject to Social Security taxes are increasing significantly this year. This does not affect retirees who are not working, but it matters for those still employed or with working adult children. The maximum taxable earnings ceiling rises from $176,100 to $184,500. This means higher earners will pay more into the system, which supports the program's long-term health, but also highlights ongoing funding challenges. Managing retirement finances requires staying informed about all these moving parts. Your Social Security check is a reliable income source, but it is one piece of a puzzle including Medicare costs, taxes, inflation, investment returns, and living expenses. The best approach is an annual review of your entire financial situation, ideally with a retirement planning specialist. Examine your Medicare coverage during the enrollment period, review your tax withholding to avoid surprises, and adjust your spending and savings based on the actual dynamics of your income and expenses.